Welcome back, and today I have Sean Cramer from Highlands Mortgage with us. We're going to talk about mortgage rates, how they're influenced, why they're influenced, and maybe some myths about them. So let's go find Sean. If you find this video informative, but you have questions for Sean or I, you can book a call with us. Just find the link in the description and schedule a time that works for you. Hey Sean, how you doing?
Good, man. Good to see you.
You too. So thanks for joining us.
Yeah.
It's a little cold, so we're gonna walk and try and stay
keep the blood pumping.
Keep the blood pumping.
Yeah.
So mortgage rates.
Yes.
2022 was a crazy year.
Yeah, a little bit.
Historically low rates.
Yep.
And then they pumped quickly.
They did. Yeah.
And there was a little bit of a retreat in the summer for, I don't know, what was it, maybe 15 or 20 days?
Yeah, there was a small retreat, I think in June. We were duped. We were hopeful.
Yes, they tricked us. But then they went right back up.
They did.
So there has to be something that's influencing mortgage rates. And what is that? What is, or actually, rather than well, let's get in that in a minute. What are the myths of what influences the mortgage rates?
Probably the biggest one is the Fed action. You know, I can't tell you how many times I heard people over 2022 say, oh, the Fed's going to raise rates again, mortgages are going up. And what the Fed influences, or what the rate that they raise, is nothing to do with mortgages directly. They raise the fund rate, which is totally different. Mortgage rates are dictated by bonds.
Okay.
So the higher the demand for mortgage bonds, the lower the rates go. And what we had was a huge lack of demand, and that was driven by inflation. If you're an investor, why would you want a mortgage bond yielding 3 or 4% when inflation's 9%?
Right. So now we're getting into kind of what actually influences mortgage rates. So what are, I don't know, 3 of the top things that really affect mortgage rates?
Demand for bonds. Well, inflation was huge this year. That was really the sole driver of what we saw.
Is that the catalyst every time, or is it just this particular time? Was that the main
Not
reason?
every time. This particular time, that was the biggest culprit. And now that that's subsiding, we're seeing rates come down.
Yeah, they are. I think at some point last week we were at 6.125.
Yeah.
So we're going to break the 6 mark here, or dip back down into the 5s here real soon.
I would expect that, yeah.
So you're talking about inflation rather, and what I heard, and this makes complete sense when I heard this, and you can verify. If inflation's at 8%, investors on the mortgage side, for them to get their money back, or not even get their money back, but to break even, they're going to have to set the rate at 8% just to break even. So generally they're going to maybe be a little bit above that, and once inflation starts getting under control and starts coming down, then they can adjust their rates, which essentially affects the mortgage rates.
Yeah, generally, I mean, it's if your return is only on pace with inflation, then you're really treading water. You're not making money, right? So there's reasons investors may choose to go there, maybe a safe place to just park it, not lose anything. But generally speaking, that demand's going to be really low.
Right. And just for everyone that's watching, what we're just talking about, that is very much top surface explanation of that. We can really get
10,000 foot view.
Yeah, we can really deep dive into that. Maybe that's another video, but in general terms speaking, like that really hit home for me when I heard it.
Yeah, it's demand, right? If nobody wants to buy a mortgage bond at yielding 5%, we need to get people to buy mortgage bonds. Nobody's got enough money to keep the housing market going, right? We'll run out of money. The big banks will run out of money. Fannie Mae will run out of money. Everybody will run out of money. So the whole thing has to keep moving.
Yeah, no, makes sense.
So rates have to go up until they find demand again.
Well, let's talk about activity then.
Activity's up. So I have not looked today, But I looked Friday, so mortgage applications are a really good indicator of demand. And Friday, the first 20 days of January, incoming mortgage application activity was up almost 100% over the first 20 days of December and the first 20 days of November. So I think people are becoming aware rates are lower
Right.
and on the way down. And I think a lot of people might be thinking, you know, I might want to get on this before everybody else does and try to beat the rush.
Yeah, certainly. All right, so let's backtrack a little bit because my brain wasn't thinking about this earlier. But when we're looking at kind of seeing where mortgage rates are going to go, either up
Sure.
or down, talk to me about MBSs.
Mortgage-backed securities are the bonds we talked about, and, and there's technical analysis you can do, right? Charts.
Oh, for sure.
And so I follow the charts for the MBS as well as the 10-year because they move closer together. But there's a lot of indicators, and we're in sort of a high traffic area right now. As inflation continues to improve and we break some of these levels, really we have a lot of improvement with no headwind ahead of us. So, you know, I would not be shocked if we saw rates significantly improve in the coming months.
So, and basically, when the MBSs are getting traded at a higher mark, that's just, for all intents and purposes, a good indicator that rates are going to improve, be lower.
Yes, so mortgage-backed securities, the higher those trade, the lower the rates are. The 10-year is opposite. The lower the 10-year is trading at, the lower the mortgage rates are.
Well, great. So, Sean, I really appreciate your time.
Yeah.
You're a well of knowledge. So basically, what we learned here today, to indicate where, specifically this market, where mortgage rates are going, see where inflation's going,
Yep.
see where the MBSs are being traded. The third thing is, and it's kind of the bonds that you were talking about, that's kind of goes with the MBSs. Don't pay attention to the news and have them saying about mortgage hikes.
The
And
media is there to sell ad space,
Right,
not spit the facts.
right. So there you have it. That's the truth about mortgage rates. It's not what the feds are doing. It's all about the bonds, what that market is doing, inflation, and maybe another 10 years when we hit a slow period, we'll come back and we'll talk about what's driving mortgage rates to go up in that scenario.
Yeah. The only thing I would add too is, since you brought up the media, is there's a lot of talk about recession, and that is historically good for mortgage rates and for housing. If you look back, housing does well through recessions, and the reason is money gets cheap. So
Well, and let's have a part 2 since Sean brought it up. He just volunteered himself to have a part 2 of this. So let's do another video about that.
All right. Sounds good.
Well, we thank you for watching, and if you like this, make sure you subscribe, hit the bell button. That way you get notified of all this good information we're putting out every single week. Thanks.